Let's talk tariffs. On Friday, April 4th, we saw the largest single point drop in the stock market since March of 2020. And for many investors, especially those nearing retirement, this is terrifying.
These tariffs and their potential impacts, Tom?
Well, consider this. All the post-election stock market gains enjoyed were gone yesterday. That makes today's hole even deeper.
So what's causing this? This is primarily due to President Trump trying to level the playing field between the US and other countries on import taxes, something we call reciprocal tariffs. Now, on April 2nd, Liberation Day, President Trump announced reciprocal tariffs on all countries across the entire globe. That's when we started to see the stock market fall. And of course, China retaliated, putting a reciprocal tariff on us here in the US, and it came in much higher than anticipated, which is what caused the big sell-off on Friday, April 4th.
Today, he has now visited one of his Gulf properties every day since announcing those tariffs. And tomorrow, the president will be back at the White House in meeting with Israeli Prime Minister Bibi Netanyahu, and an official says that tariffs will be a subject of their conversation.
Now, I know you're here because you're wondering, what's going to happen to my money? But first, before we dive into that, let's understand how this impacts literally everything from the stock market to inflation to interest rates and what you can be doing to protect your money and even make a profit. First, what is a tariff? Tariffs are taxes charged on goods imported by other countries. Trump's theory is if they can make imported goods more expensive, Americans will be more encouraged by locally made goods, which will help American businesses not just survive but thrive in their home country and also increase revenue that is collected by the government on these imported items. Now, one thing that's very important to know is that tariffs are paid by the person or the company that does the importing. So these tariffs are what we know as an additional tax. This money has to get absorbed somewhere, and typically this cost will get passed all the way down to the consumer, which is you. Let's take a look at cars for an example. If an American-made car costs $50,000 and a car imported from overseas only costs $25,000, well, Americans are more likely to buy the imported car because it's less expensive. But if the government imposes a tariff on the imported goods that doubles the price to $50,000, well, now we have leveled the playing field in the buying market, and Americans are much more likely to buy the American-made car. So while tariffs could be good for American businesses, they could also drastically increase the cost of everyday items, leading to inflation, unemployment, and so much more. The other question I hear is, so why is Trump imposing all of these tariffs? Well, there are a few speculated reasons as to why. First, the US has been in a trade deficit for the last 50 years, basically meaning that we buy more goods from other countries than they buy from us, yet they charge us a higher tax to sell our goods in their country. So basically, they buy less from us, but charge us more to sell our goods in their country. So Trump is just trying to make it right. These tariffs are what we know as taxes, were really put in place to just level the playing field and charge other countries the same rate that they charge us. The other speculated reason is because Trump needs the feds to lower interest rates. Now, if you missed it, I did discuss this in a video that I released last week on my channel, and you can catch the link to that in the description below. But if you don't know, the US is currently $36 trillion in debt and counting, and $7 trillion of that debt is coming due in the next 6 months. And newsflash, we can't pay it. So Trump needs to refinance it. Now, he is waiting for the feds to drop interest rates because he can't do that with the rates as high as they currently are right now. But due to fear of inflation, Jerome Powell has decided not to cut interest rates anytime soon. But Trump knows if the stock market were to drop, the feds would be forced to cut interest rates to help stimulate the economy, ultimately giving him the leeway that he needs to refinance the debt. So as you can tell, there's a lot going on in the economy right now. And the scariest part is this could all be completely different in just a week. And that being said, we also don't know for how long this is going to continue. So if you're an investor, maybe you have money in a 401k or an IRA, maybe you're nearing retirement and you're getting closer to actually needing to access that money, you've got to ask yourself one big question. Do you ride the wave or get out altogether. If you choose to ride the wave, you need to remember that when you lose money, you lose time. Every dollar that you lose could potentially cost you years off of your retirement. And every time you lose money, most cases you have to earn almost double the interest just to break even. For example, if you had $100 and you lost 50% of that, you would be left with $50. Now, if you gain 50%, your statement would tell you you're at a net zero average rate of return, right? But you're actually only at a balance of $75 because it's 50% of the 50 that you had after you lost money in the first place. Now, what do you really need to grow by to break even? You'd need to grow by 100% to get back up to that $100 that you initially started with. Double the interest that you lost. And who knows when that's going to happen? If you choose to get out altogether, what does that look like? Well, a lot of investors have already started shifting out of stock and into bonds. For example, US Treasury yields have fallen because so many people are looking to buy them right now because of all of the uncertainty in the stock market. And Treasury bonds are just simply loans that you're making to the US government, so they are considered relatively pretty safe. But the problem with bonds is they don't really earn much interest. Your money kind of just sits there collecting dust. But there is another popular solution that millions of Americans are flocking to right now that still gives you the downside protection when the market is dropping, but allows you to capture the growth of the stock market when it's doing well. And it's called an FIA, or what we also call a Fixed Indexed Annuity. And according to LIMRA, the Life Insurance Marketing Research Association, just some $432 billion went into these accounts in 2024, and that number is expected to rise in 2025. FIAs work very similar to a bank CD, where your money is on contract with this time an insurance company as opposed to just the bank. And the insurance company is designed to have your money for 5, 7, maybe 10 years. And in exchange for the contract, they give you that guaranteed floor so you can't lose money when the market drops, the potential to grow when it does well, and they allow you to actually pensionize that account and take an income stream out in retirement that will last you for as long as you live. My question to you is, for how long are you going to wait before you're going to make a move? The most important thing is that you stay educated and informed over the coming weeks. So if you need to make a quick move with your money, you can do it. Remember, this video is for educational purposes only. I recommend you connect with a licensed financial professional before you do anything. And make sure you subscribe so you do not miss another market update that affects your money. I'll see you next week. Bye for now.